Welcome back, viewers, to your favorite channel for all things finance and tech. Today, we're diving deep into the whirlwind world of Wall Street, where records are being shattered left and right thanks to the explosive rise of artificial intelligence technology. Buckle up, because this is one ride you don't want to miss. Let's start with the headlines. Wall Street barreled to new records on Wednesday, driven by the unstoppable frenzy around AI technology. The rally propelled Nvidia, the poster child of the AI boom, to a staggering market value of over $3 trillion for the first time. Yes, you heard that right, trillion with a T. The S&P 500 surged 1.2%, topping its all-time high set just 2 weeks ago. The Nasdaq composite wasn't to be outdone, jumping 2% and also setting a record. The Dow Jones Industrial Average, which has less tech exposure, lagged behind but still managed a respectable gain of 96 points, or 0.2%. So, what's driving this market madness? Some tech companies have been posting fatter-than-expected profit reports, fueling investor optimism. Take Hewlett-Packard Enterprise, for example. It skyrocketed 10.7% after reporting strong sales linked to AI systems, and even raised its financial forecasts for the year. Looks like AI is not just a buzzword, it's the rocket fuel propelling these stocks into the stratosphere. Leading the charge is Nvidia, whose chips are at the heart of the AI revolution. Nvidia shares jumped another 5.2%, bringing its gain for the year to a jaw-dropping 147%. This chip titan has now joined the exclusive club of U.S. stocks worth over $3 trillion, alongside tech behemoths Microsoft and Apple. Speaking of which, Apple climbed 0.8% on Wednesday, regaining its $3 trillion crown. Other big tech names were also in the green. Microsoft saw a 1.9% rise, Meta Platforms jumped 3.8%, and Broadcom rallied 6.2%. Even cybersecurity firm CrowdStrike got in on the action, climbing 12% after posting better-than-expected profit and revenue for the latest quarter. By the end of the day, the S&P 500 had risen 62.69 points to 5,354.03, the Nasdaq jumped 330.86 points to 17,187.90, and the Dow added 96.04 points to close at 38,807.33. Quite a day, wouldn't you say? However, not all was rosy in the retail sector. Dollar Tree took a 4.9% tumble after matching analysts' profit expectations but missing slightly on revenue. The retailer is also mulling over selling or spinning off its Family Dollar business, highlighting the ongoing struggles for lower-income U.S. households grappling with high inflation. In the bond market, Treasury yields fell following some mixed economic data. One report showed the U.S. services sector returned to growth last month, beating forecasts. More importantly for Wall Street, the report indicated that prices rose at a slower pace in May than in the previous month. Another report suggested that hiring slowed more than expected last month outside of government roles. This kind of data has been making stocks a bit jittery recently. The hope on Wall Street is that a slowing economy could help curb inflation and prompt the Federal Reserve to cut interest rates. But there's always a risk of overshooting, which could lead to a recession, a scenario that would certainly put a damper on stock prices. Treasury yields sank further on Wednesday, with the 10-year yield dropping to 4.28% from 4.33% on Tuesday and from 4.6% a week ago. The bond market's next big moment? Friday's U.S. government monthly jobs report. Economists expect this report to show a slight uptick in hiring, a delicate balance between slowing growth and avoiding layoffs. The worst-case scenario for markets? If the jobs data and other economic indicators come in stronger than expected, the Federal Reserve might be pushed to hike interest rates even further. This would place additional strain on the economy and investment prices. But don't panic just yet. According to J.J. Kinahan, CEO of IG North America, this scenario is less likely than others. Looking beyond the U.S., European stocks rose ahead of a crucial interest rate decision by the European Central Bank. Investors are hoping for a rate cut amidst concerns about the continent's economy. Meanwhile, over in Asia, markets were mixed. Tokyo and Shanghai saw declines, while Seoul's index rose by 1%. Now, let's zoom back in on the driving force behind this market rally: artificial intelligence. AI is not just a tech trend, it's becoming the backbone of modern innovation. Nvidia's dominance in this space, thanks to its high-performance chips, is a clear testament to the pivotal role AI is playing in today's tech landscape. Hewlett-Packard Enterprise's recent success underscores how companies across various sectors are leveraging AI to boost their performance. Whether it's optimizing supply chains, enhancing cybersecurity, or developing new consumer experiences, AI is the game changer. But what does this mean for the average investor? Simply put, the AI boom is creating opportunities across the board. Tech giants like Microsoft, Meta, and Broadcom are not just riding the wave, they're shaping it. And with AI applications expanding into new industries, the potential for growth is enormous. However, as with any rapidly advancing technology, there are risks. Regulatory scrutiny, ethical concerns, and the sheer pace of innovation can create volatility. Investors need to stay informed and be prepared for a bumpy ride, even as the long-term outlook remains incredibly promising. On the consumer front, high inflation continues to squeeze lower-income households, as evidenced by Dollar Tree's struggles. This highlights a critical tension in the current economic landscape: the tech sector's meteoric rise versus the broader economic challenges faced by everyday consumers. As we look ahead, all eyes will be on the Federal Reserve and its upcoming decisions on interest rates. The central bank's moves will be crucial in determining whether the current market rally can be sustained. Lower rates could fuel further gains, but the risk of inflation remains a constant concern. For investors, this environment calls for a balanced approach. Diversification is key, as is staying abreast of both market trends and economic indicators. The AI sector offers tremendous growth potential, but it's essential to keep an eye on the broader economic picture to navigate the risks effectively. And that's a wrap for today's deep dive into the latest market frenzy driven by the AI revolution. We hope you enjoyed this comprehensive look at the forces shaping Wall Street and beyond. Don't forget to like, subscribe, and hit the bell icon for more in-depth analyses and the latest financial news. Until next time, stay savvy and keep investing wisely.